A lot of the questions we get are surrounding what type of records people need to keep and how long they need to keep them. Also, many people are seeing these other technologies available and wondering what alternatives exist to the traditional record keeping which we have of keeping all of our original receipts. So, starting off, what I usually like to say as a good rule of thumb is to keep records for at least 7 years. This will cover most all issues with taxes or financial reporting. However, we should always remember the caveat that longer duration purchases, investments, etc. should always have records kept for at least the life and duration of that purchase or investment, and then another 7 years or so after that. We could think of examples like this as the purchase of a home. You might live in your home for 25, 30 years and sell that home at some point. We of course will need the records for both financial purposes and tax reporting purposes to establish what the original cost was of that home, the improvements you've made over time, etc. Many people don't realize that these records have to be kept that long because they use the rule of thumb of 7 years. But of course, always when keeping records or when establishing a time frame, determine what the amount of time necessary is and what the duration of the purchase or life of the asset that you're keeping records for. Very importantly, and another topic that gets brought up is, of course, with all of these records, with the voluminous amount of paper that's being generated today, how do I keep track of this and where do I keep track of this? Well, very importantly, everyone should know that the IRS has made provisions for people keeping these records electronically. As a rule of thumb, I still encourage my clients to keep the paper records. It's very easy to stuff receipts in a manila envelope and put it in a filing drawer for later. But as a very excellent proactive thing, it's wonderful to get in the habit of scanning your receipts, scanning those accurate records, and using one of a number of available technologies to store those over time. Of course, you want to make sure with all records to have accurate and valid backups in these cases, especially if they're going to be electronic records. And if people are wondering more specifically about what the IRS accepts as electronic records, they could look at Revenue Procedure 97-22. Very importantly, along with that, the IRS has said that they will allow the destruction of those records in 97-22 after scanning, but again, I still encourage people to hold on to the records if at all possible. Valid types of records that people might want to consider keeping are some of the following. With regard to business or personal expenses, things like cash register tapes, your bank deposit slips, along with that your receipt books. Things like your purchase and sale invoices, credit card slips, canceled checks, account statements, and real estate closing statements. As a very important caveat to all of these things, many people have come to rely on their financial institutions for maintaining these records. It is not the financial institution's obligation to keep these records beyond a certain number of years, so always remember that it's your responsibility to make sure you're going to have these kept accurately and safely. Again, if you have questions about these records or the length of time that you need to keep them, you could seek advice from your professional advisor, and with specific to the IRS, again, Revenue Procedure 97-22 is going to deal with electronic record keeping and any of the questions you might have surrounding that.